Hi, my name is Daniel Brown, and I'm the CEO of Myriad Real Estate Group, and this is going to be our May market update. So over the last several months, I've been talking about how the inventory in Phoenix is extremely low, and it still is. However, the Fed has started raising rates, the federal fund rate, and so that has correlated to higher mortgage rates. And so with higher mortgage rates, that's put some downward pressure on demand, and that is doing what it's supposed to. And we are starting to see an increase in inventory, albeit slow. So my last video I think that I did, I reported that there was somewhere around 4,000 active properties in the MLS. Well, right now we're up to 4,600. So that is a step in the right direction and some positive news for buyers out there that there's going to be more inventory coming to market. I am definitely in the camp where higher interest rates are going to be a good thing for the housing market. And the reason for this is our housing market has been just really unhealthy over the last 2 years. Our inventory has been dropping at a rapid rate. We've had extremely low interest rates on mortgages, and it's been this frenzy causing home values to go up at a rate that just isn't sustainable. So by the Fed raising rates to try and bring inflation down, it is going to have a downward pressure on the demand for housing because it's making homes less affordable for people, unfortunately. So for some people, it's pushing them out of the market and it's cooling off the housing market, which it desperately needs. What we will end up seeing because of this is instead of homes, getting listed and selling in a weekend or in a week, we're going to start to see the days on market for homes increase. And when that happens, we're going to start to see more homes, maybe not more homes come to market, but inventory increase because it's taking homes longer to sell. So the rate at which homes are getting listed may stay the same, but inventory will go up because they're not selling as fast because there's less buyers in the market. This cooling trend is going to give the real estate market a chance to hopefully catch up. Now, this is not going to be an overnight solution. It's going to take a long time. 4,600 homes on the market is still extremely low. And so this is still very much a seller's market. Sellers carry all the cards because there's still not a ton of choices, but we are started to head into the right direction. And demand isn't below normal, demand is finally normal. So it has dropped to normal levels with that downward pressure. Now, what we're going to be paying attention to is how low will that demand go? Will we start to drop below normal so that we start to see that inventory continue to climb? My predictions are that markets are constantly seeking balance, and so our market is looking to seek balance. And so as demand falls and inventory goes up, those lines will eventually cross. So we will start to get into some sort of equilibrium in the housing market, which is going to be a really good thing. So I also predict that you are going to see a lot of articles and a lot of YouTube videos. I know that I'm already seeing it, that the housing market is collapsing and that demand is coming down and that inventory is going up. Keep in mind that this is what we want. We want demand to come down. We want inventory to come up. The market that we've been in is just horribly unhealthy for everyone. Now, obviously, all of us that own homes have been, we love that rate of appreciation, but for long term, it's just not sustainable. So they've got to put the brakes on this housing market somehow, and the tool to do that is higher mortgage rates. Now, the Fed has 6 to 7 rate hikes planned this year, ranging, people are predicting anywhere from 0.25% to 0.5% each rate hike, with the next one probably happening in May. And so rates have popped, and they are really high, historically low, but high from what they were at the end of last year. And as of this recording, we're just above 5%. And so I think that we are going to start to flatten out a little bit in the mortgage rates because I think that those 6 to 7 rate hikes are already baked into the market, which is why it increased so fast in such a short amount of time. With these 6 to 7 rate hikes, I do believe that the Fed is going to push us into a small recession. I think that we are going to start to see unemployment numbers creep back up. I think a large portion of those unemployment numbers, and if there is a bubble in real estate, I think that it exists in real estate employment. I think the market is saturated with realtors, lenders, and title companies. There are way too many of them, and I'm already starting to see articles about Quicken Loans just offered a buyout to 8% of their staff. Wells Fargo laid off a bunch of people in their mortgage department. Better.com has had horrible articles written about them and laying off tons of people. And a lot of people got into the mortgage industry during the refi boom that took place over the last 2 years. And I don't think that they're going to survive because the number of refis are just going to, there's not going to be many of them at all. So I think that the market is oversaturated in terms of employment in the real estate industry. So I think those people will be looking for jobs elsewhere as they won't survive this shift in the market. So that's where some of that unemployment rate is going to come from. And so with that mild recession, that's actually going to be an opportunity for a mini refi boom. So for those lenders that survive over the next couple of years, whenever that recession takes place, when we have a recession, we always see a drop in bond yields, which will then therefore translate to a drop in mortgage rates. So for those of you that are shopping and buying a home now, while interest rates are above 5, if you can afford that monthly payment, I still think it's a very good idea to lock in, get your home at the price that it is today, with the hope and the expectation that we will hit a recession within the next 2 to 3 years, where you will have an opportunity to refinance that mortgage, and I think rates will get back down below that 5% at that time. So again, it comes down to what your affordability is and on a monthly basis, but if you can pull the trigger, I think the home is going to be worth more in the future than it is now, and you'll be able to refinance that rate at a later date. If you're a seller, I think you're going to need to expect longer days on market. So I think that the frenzy is starting to give way a little bit, and longer days on market should be the expectation. And honestly, it's more healthy, right? It's wonderful when you list a house on a Thursday and you're under contract by the following Monday. As a listing agent, I know I love that, but that's not healthy for the market. It should take longer to sell the house. So I think that people need to start to expect for it to take 2, 3 weeks, 30 days, 60 days. That is more traditional. And so for us to get into a balanced market based on demand, we should be at 3 to 6 months. Right now we're still, hovering around a month, maybe less of inventory. So it will be interesting to watch to see if this trend continues with increase in listings and inventory on the market, and watch where that demand goes. So next month I will be looking at the numbers for May to report to you if that trend has continued or not. Which leads me to my final piece of recommendation that I got from a very good friend of mine. He told me over coffee one day a couple weeks ago that the best time to buy a house was 5 years ago. The second best time to buy a house is now. So, if you're always forward thinking, homes traditionally appreciate over time. I think that trend is definitely going to continue. If we do hit a recession, it's only going to be helpful to the housing market, bringing those mortgage rates down. So if you didn't buy a home 5 years ago, the best next time to buy is now. Thank you so much for tuning in. If you have any questions about this month's market update, please let me know in the notes. Don't forget to give a like and subscribe, and we will see you next time.